Happy Thursday out there, Team 42. It's your skipper here, Darius to present our macro minute for Thursday, July 24th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk or to get on the right side of market risk to the extent you haven't been following Kiss and Dr. Mo, you need to be a client of 42 Macro. So today's key macro question is, how is the global economy faring amid U.S. trade policy uncertainty and the Trump tariff shock? Our answer, to borrow a phrase from our friend Michael Guyot, exquisite. The preliminary July PMI data from around the globe was supportive of our view that both the U.S. and global economy are poised to generally and persistently surprise to the upside over the medium term. Prior July 12th around the horn, with respect to the medium to long-term time horizon, the surprise risk in financial markets is still asymmetrically skewed to the upside from both a top-down GDP perspective and a bottom-up corporate sales and earnings perspective. This implies any correction is likely to be shallower than it would otherwise be. Our positioning model still suggests we are likely a long way away from paradigm C being fully understood and positioned for by investor consensus. Of the world's 12 most investable economies, our grid model is currently forecasting real GDP growth to generally surprise to the upside over the next 12-month forecast horizon in 10. Brazil, Canada, China, Eurozone, France, India, Japan, Switzerland, UK, and the US. Moreover, consensus growth estimates have bottomed and are improving in Brazil, Canada, Eurozone, India, UK, and the US. Elsewhere, the latest jobless claims data indicate continuing claims are back to signaling, or initial jobless claims are back to signaling a low probability of a developing recession in the US economy, which is far more sanguine than the current consensus implied recession probability of 35%, which is more than twice a normal level. The latest failed breakout in jobless claims represents the fourth such rolling recession since the current business cycle began. Fiscal dominance is a pain in the you-know-what for bears stuck risk managing the prior monetary dominance regime. Lastly, homebuilder stocks are breaking out to bullish according to our volatility-adjusted momentum signal, which is supportive of our paradigm C-inspired view that the Trump administration is likely to pull the deregulation lever to provide relief to the housing market over the medium to long term. Much like the market itself, nothing is more bullish than stocks breaking out on bad news. Transitioning to our 42 macro dashboard, as always, we'll wrap up with a question from our community. This one's titled Tariffs. It says, hi, Skipper. To what extent could the lack of trade deals weigh on asset prices in the short term? I know you've been banging the table on tariffs being something investors are now looking through, but if the Fed continues its unfavorable policy next week at a time when a significant number of tariffs are likely to be put back in place, I would imagine this would pressure risk assets. However, the reaction of the market to today's PMIs perhaps implies the drag from tariffs is simply not large enough. As you noted, only 11% of GDP is in fact impacted after all. Thanks for your amazing work. So thank you for the kind compliment. I'll say a couple things on this. One, just structurally, I think if you're out there trying to trade every wiggle in the stock market, the crypto market, the commodities market, the currency market, the credit markets, or the fixed income markets, you're going to struggle as an investor because there are people with billions of dollars of technology and hundreds of millions of dollars of human capital that are trying to do that. And if you're on the other side of that, God help you. So, as an investor, particularly as a retail investor, and I'm speaking directly to retail investors right now, your goal with every investment decision that you make in your portfolio should be with the goal of retiring on time and comfortably. And so when you think about, okay, how much risk is in the market over a short to medium term time horizon, you should be thinking about it from the perspective is, what is the probability the market will suffer a crash and impair all the capital that I spent my, career saving? And so when we think about, how much crash risk is sort of present in financial markets, we do that through a variety of metrics, but one of the most kind of forward-looking models that we have is our positioning model. Our positioning model looks at long-term time series across 16 features that have historically, created fantastic signals at the peaks and troughs of markets in terms of, generating a maximum amount of dispersion in those time series that signal to investors, hey, we're probably at a, bearish, low, or we're probably at a bull market high. And so right now, when we look at the indicators, the 8 indicators in our positioning model here over to the right that correspond to the longer term outlook for the market, let's call it 12 months or on a 12-month forward time horizon, they're only signaling moderate risk of a crash in risk assets over that time horizon. Recall that this same exact model at the all-time high, the prior all-time high on February 19th, signaled high risk of a crash. Right, the positioning cycle was much more full back then, and so it's our view that in the context of our paradigm C theme not being fully understood and fully positioned for across global financial markets, and again, we're three plus months into positioning for paradigm C, helping our clients position for paradigm C. Week after week after week, we continue to observe upside capitulation across global Wall Street into our paradigm C theme. But the reality is it's not fully consensus. And part of the reason it's not fully consensus, taking it back to the question, is the fact that, respectfully, the mainstream media keeps myopically focusing on tariffs. But tariffs is only one leg of the multi-leg stool that the administration is using from a policy lever perspective to engineer an economic boom on a net basis, in terms of all the levers being pulled. So it's our view that we're going to be on this paradigm C train for quite a while, and we're quite proud of ourselves and our clients for partnering with us for recognizing paradigm C months before global Wall Street did, and so obviously we were in line buying before they've been forced to buy, and we've been calling for their upside capitulation since early May. Going back to the hiccups, who cares if the market hiccups? The market's going to hiccup, but guess what? There's a whole legion of institutional investors that are trapped underneath the last price of the market that need to capitulate to the upside. So in our view, that's highly likely to insulate any pullback. And that's the point we've been making since early May, that, hey, consensus doesn't understand paradigm C and far from positioning for it. So it's our view that even if we are likely to see some, tariff-driven volatility in the coming weeks, as a as a function of both the tariffs and also the Fed's adverse reaction to the tariffs in terms of not cutting interest rates, I would caution investors. Anyone trying to short into that, in my opinion, is highly likely to be disappointed in the context of our paradigm C theme, which in our view is not really fully proliferated across global Wall Street. But guess what? It probably will, just like our resilient U.S. economy theme did, the theme that we authored back in the summer of 2022. So hope that was helpful. I did have one more thing that I was trying to get across. If I remember it, I will bring it up tomorrow.